science. I did a summer in banking while we were returning next year. And we'll be just kind of walking through the DCF. So feel free to stop me at any time if you have any questions. We'll kind of run through some slides really quickly, and then we'll just basically walk through an Excel model together. But anyways, so obviously we all kind of have heard the term DCF, or right, tossed around a bit, I assume, if you've stepped foot in kind of in that finance realm. And so what it is, right, is an intrinsic way to value a company, and you're valuing based on cash flows. And so in a DCF, right, you're going out in theory, or at least in a perpetuity growth, into infinity, right? So as you can see here, right, we have the cash flows, and then we take the present value of those future cash flows and discount them. We sum those up into infinity. And now what we'll kind of be doing is we're talking about how we get those cash flows, and then how we figure out what the terminal value is. As those are the kind of the main important drivers of a DCF. So projecting cash flow, this is kind of simple, right? You've probably seen this formula before, but right, we start from EBIT, we take away taxes, we add back D&A, right, because it's a non-cash expense. Then we take out CapEx and a change in net working capital. We'll dive into this a bit more when we get into kind of like free cash calculations when we start modeling. And then so terminal value. There's two ways we calculate terminal value typically in a DCF. The first is perpetuity growth, or sometimes also called the Gordon growth method. And for that, what you do is for your last year of the terminal value, you do the free cash flow from that year times 1 plus the growth rate divided by R, which in this case, we typically use WACC if you're using unlevered free cash flow, or you'd use cost of equity if you're using levered free cash flow, and you subtract that from the growth rate. We can kind of get into why this math works. It's kind of the mathematical formula. At least for me, I've kind of just stuck by it, accepted it. But as you can see here, essentially, it forms out into a perpetuity. Then exit multiple. And so this is actually the more common method used in the industry, just typically because it's kind of unrealistic to think a company will grow at a stable rate over, into infinity. And so what you do is we'll take the final year's EBITDA, revenue, EBIT, depending on kind of what metric you're looking to do, and multiply that by a multiple. So in this case, typically we're doing EBITDA, but in the past people have obviously done EBIT, EV revenue for a company maybe that has a funky EBITDA. And then WACC, and then so this is our discount rate, weighted average cost of capital. So it takes into account kind of two things, right? It takes into account the cost of debt and the cost of equity. It's essentially the cost, right? The cost of capital that a company needs in order to issue debt. Okay, oh, sorry. Kind of in order to gain funding from investors. And so the formula, right, is the amount of equity, E, over equity plus debt. So essentially that's percent of equity times the cost of equity, which here is kind of like the return rate of equity, which we get through the CAPM model, capital asset pricing model, which we'll talk about in a bit, times the percent of debt over here, times the cost of debt, times 1 minus the tax rate. The reason we do 1 minus the tax rate is because debt obviously is tax deductible, so you have a tax shield, and so that would typically makes debt cheaper than equity. In addition, over here, this is the CAPM model. We'll talk about it briefly when we go into WACC and how to calculate it, but really it's the risk-free rate plus the beta times the market risk premium. And so the market risk premium, right, is the historical return of the market minus the risk-free rate. For the historical return of the market, usually, we're talking about the S&P 500, which is, around 9% over on average. And this is how to discount, but kind of, I think what we'll do now is I'll move into the Excel model and we'll kind of walk through that. Once again, guys, feel free to stop me if I go too fast, but can everyone see the Excel? Okay, cool. So what we'll be doing is we'll be looking at Walmart, pretty stable company, nothing too crazy here, but we'll kind of take it step by step and kind of walk through how we get from just some, statements here into a actual fully working valuation. So as you can see here, we brought out kind of the income statement for Walmart. So I'm not sure kind of the resources you guys have at your school, but for us, we have Cap IQ, so we typically download these from Cap IQ. You can manually do it from, say, 10Ks, right? Going to BAMStack or Edgar, and getting all of the listings. But these are all historical data. We'll kind of work about the financial projections part, the modeling part, which is kind of probably the more interesting part. But kind of what you want to do, once you get those numbers in, is we'll calculate growth rates. And so in this case for revenue, right? So the formula for growth, right, is simply, current year divided by your previous year minus 1, right? And then we drag that formula across. And now what we might want to do is, right, we're projecting Walmart into the future. I assume for you guys, when those of you that have done stock pitches in the past, you'll kind of dive deeper into what you think the revenue growth will be. But I haven't looked too deeply at Walmart's catalyst. So for all intents and purposes, I'll take an average of the past 2 years, locking that, and then we'll drag that formula out. And so we'll say that's our growth rate for the next 5 years, right? And then in order to get right kind of what our revenue will be, simply we do the math and we multiply that the previous year times 1 plus the growth rate, right? And then we can drag that out. So do we have any questions on that, guys? We're all good there. Cool, awesome. And so kind of the next part is revenue is the only thing we do on a growth rate. Everything else typically in a model we want to do is a percent of something else. And for most things on the income statement, especially now that, we're not going to go too deep into this model, we'll do is a percent of sales. So how we calculate that is we look at the current year's item, so in this case, cost of goods sold, and we divide it by that year's revenue, right? And so we'll do that, and that formula will be dragged across for all, the historical years. And then what we might say is, it looks like cost of goods sold is on average 75% of revenue. And that makes sense, for Walmart, right? They're buying, costs a lot to buy all the goods that they sell. And so what we'll do is, we'll take an average. And then once again, guys, I'm being a little lazy here. I know Joseph knows, but typically, at least for us in CFC, we like to, think through these numbers a bit more and not just, throw a historical average on there because, we thought that makes sense. But for this case, we'll do that. So now that we have those averages out, right, simple formula, right, we just do what the revenue for that year is multiplied by kind of the percent of sales, and we'll drag that out. And then, yeah, and so we'll do that kind of, we'll go through and we'll do these for the next ones. And so, here, let me do, yeah. And so we'll do that. And so, right, so this is an average. We'll do an average of SG&A. That kind of, makes sense. We don't think they're suddenly going to have to invest a lot more in, the amount of people that sell their goods, right? Pretty logical. And then, we'll do the same thing. We'll do this times this one. And then what we'll do actually is we can lock the row. That'll make our lives a bit easier going forward. And then now what we could do is, take the average of this. And then, so sorry, guys, I was getting a little ahead of myself. So here for interest expense. So in an actual model, we would start creating debt schedules. We would go into their Walmart's 10K, look at when their next debt issuances are due, kind of model out how much they'll be paying. But for this model, and just so we can get it working, we're just going to do it as a percent of sales. I'm acknowledging this is very much the wrong way to do it. This is the cheap, the lazy way out. But for our purposes, it looks like these debt payments are pretty similar year to year. This interest income pretty similar year to year. So we'll do that. But for today, we're not doing a 3-statement model. I think Joseph and I talked about it, but we don't want to keep you all Sunday. There's some good football going on today. So we'll just do this for now. So we'll take an average of these, and we'll drag that across. And what we can do actually is also copy this formula, and then that'll be fine, right? And then to this, we'll do another average, drag it across, And then we'll once again copy that formula, right? All right. And so as you can see, we're starting to get numbers that are making sense, right? Looks like we're on par. Our net interest expense is pretty similar year to year. Over here, right, our operating income, EBIT, pretty similar year to year. That's a good way to sanity check, right? If this went from 22 billion all the way to 30 billion, I probably might have done something wrong, or my growth rates are really kind of crazy. But that's a good way. You kind of want to check that year to year stuff's making sense, right? There should be a trend. Other unusual expenses. So this is a line item included on the income statement oftentimes. But to be very honest, like companies kind of shove a lot of stuff in here. You kind of have to go through the notes and figure out what's going on there. For what we'll do for now, since at least in my eyes, it's hard to really predict what other unusual expenses Walmart might face, especially COVID related. We'll just put 0 here for now. Obviously, in a real model, we might want to dive deeper into those numbers, kind of figure out what's going on there. All right, cool. So now we'll move into tax rate, right? Pretty similar. We all know the tax rate is 21%. We can drag that across. And then, right, so the tax rate is the EBT, or the taxes paid is the EBT times what the current tax rate is. Drag that across. All right, kind of minority interest. Once again, this is something that shouldn't be projected as a percent of sales, but kind of for our purposes, we'll just kind of run with it for now. So we'll lock that, drag it across, and then this line, percent of sales, I want to say. All right, and so we now have a decent, fully functioning income statement. So I'll pause there, guys. Is there any questions on the income statement that I can answer, but kind of before we move into some of other items? All right, cool, perfect. So now kind of we're doing, we did the income statement. That's probably the most important thing in order to kind of get a DCF rolling. But the other things, right, we talked about that unlevered free cash flow is EBITDA minus taxes, but you also need to subtract out CapEx, and you need to add back D&A. And so those are two line items that are typically seen in the cash flow statement as well as the balance sheet. But for our purposes, we're not going to do the whole balance sheet, right? That can get pretty messy trying to balance it out, especially in just, in an hour. So what we'll do is we'll just do a CapEx schedule. And so here we brought down the items. So net PP&E, that's from the balance sheet. CapEx you find in the cash flow statement, and then D&A you can either find in cash flow or you can work it out from the balance sheet. And so what we did here is CapEx is typically as a percent of sales, right? If you make a lot of money, you're probably going to invest a lot back into your company. D&A we did as a percent of the previous year's net PP&E, and that kind of makes sense, right? Depreciation is kind of how much your assets go down, so it would make sense that it would be based on your previous year amount of plant, property, and equipment. So what we'll do, the same thing we've been doing all these times, right? We'll take an average of these, and we'll drag that average out. And then for this one, what we'll do is we'll take another average. We'll lock that, and then we'll drag it out. All right. Now this is kind of where it gets a bit different, right? So CapEx is a percent of sales. We've all seen that before, right? So we do this times the percent of times sales, and that makes sense. And we can drag that out. But now what we want to do is D&A is a percent of last year's net PP&E, right? So now what we do is we do this 10% times the previous year's net PP&E. But when we drag this out, right, we're going to start getting zeros because there's nothing here. And so in order to calculate net PP&E for the year, right, you would do the previous year's net PP&E, then we would add in the current year's CapEx, right, because CapEx is what's increasing your PP&E, right? That's the investment, while also subtracting the current year's D&A. And then we drag that out. Now our numbers kind of fall in line, and we always want to take our sanity check, right? Does this make sense? D&A is around 10 billion each year. That makes sense, right? and we want to, take another look. CapEx seems to be slightly increasing, but that seems logical, right? Walmart's growing, they need to invest more, and so it's increasing. Cool. Awesome. And so down here, we have a net working capital schedule. So I'll talk about this, but we won't kind of work through it just because at the end of the day, I think you guys have seen me do project stuff as a percent of sales for a while now, and I don't want to get, beat that horse to death. But basically, right, for our purposes, we're not doing a full balance sheet. So we just need to find out the items that are in net working capital, which, is current assets, but, people depend on whether they include cash. For our purposes, we're not going to include cash. So we'll do accounts receivable, inventory, and prepaid expenses. According to Walmart's 10K, those are their main things. So we did that. We projected as a percent of sales, did the average. And also we did current liabilities. And so that's accounts payables, accrued expenses, short-term borrowing, current portion of long-term debt, current portion of leases. And so, right, these items I should have schedules for. Once again, we didn't do debt schedules. We can talk about that at another time. But as you can see, for the most part, they seem to stay pretty consistent. Like these numbers don't look crazy out of line. Obviously, we could be doing a lot more deep dive into this model if we wanted to. And I assume at all your schools you have done pretty complex modeling. But for a general overview, this typically works out. And then so what we do, right? So net working capital, sorry, I should have explained it, but right, net working capital is the amount of capital needed to run your day-to-days of a business, right? So that's why it's your current assets minus your current liabilities. And so what we did, we simply did the current assets minus current liabilities. But then for a DCF, you want the change in net working capital, right? The change from period to period, because if net working capital increases, right? So that means your assets increased, but your liabilities didn't, which means technically that cash left, right? Because when your inventory goes up, your cash goes down. And so as you can see, we did that, and then we just took the change, right? And so, right, this formula is simply year-over-year change. All right. So we projected everything out. Guys, do we have any questions on that? Otherwise, we can kind of move into the DCF. Awesome. Cool. So now what we'll do is we'll move into the DCF. And so here kind of I listed out kind of our line items. So right, as we talked about on the slide, we start with EBIT and we'll add back D&A. We'll subtract out capital expenditures. We'll subtract out the change in net working capital, and then we'll also subtract out taxes. So this part's kind of the fun, easy part. Your life's pretty easy. You just, hit equal, and then we find where EBIT is over here, right? So EBIT, for most of the time is operating income, right? So we'll do that. D&A, so D&A, find where D&A is. So D&A is right here. Then we find where CapEx is, right? CapEx is right here. We find where change in net working capital is. And, since it's a change, we didn't have it for the first year, but we'll just put that there for our purposes. And then taxes. Taxes should be right here. All right. And then kind of, I like to put these kind of plus and minuses in front of them just so I get the formula right in my head. I think I've messed it up probably 1,000,000 times in my life doing these. So, right, the formula is simply, as you can see here, we got EBIT plus D&A minus CapEx minus change working capital minus taxes. And so that's that, we'll highlight this and then we'll just paste it across. And there we go. There's our unlevered free cash flow. So we have that. Now we want to find the present value of the unlevered free cash flow, right? Because at the end of the day, these numbers are great, but $1 today is not the same as $1 tomorrow, right? And $1 today is definitely not the same as $1 5 years from now. And so we want to bring it back to the present value that will allow us to value Walmart today. And so what we do is we need to discount by the present value. And so how we do that is we take the current year's that year's cash flow, and then we divide it by 1 plus WACC. Oh, so you know what? Let me run through WACC real quick, and then we'll pop back up to here. So I filled up these numbers basically because for your guys' purpose, you probably don't want to see me running around at 10K, control Fing my way through trying to find how much debt they have on their schedule and how much, their cost of debt is. But for our purposes, we'll kind of talk them out and we'll walk through this. But the cost of debt, so on Walmart's 10K, they list out kind of their debt and then the weighted average interest rate. If you want, you could take that yourself. I took their word for it. We're going to use 3.9. Seems reasonable. Walmart's one of the biggest companies in the world. I believe they're one of the higher credit ratings too. 3.9 sounds pretty fair. Tax rate 21%. Obviously, we can get into the nitty gritty of tax credits and all, but we'll just use 21% as because that works out. So this is the current amount of debt on their balance sheets. So right, you'll go to the balance sheet and you'll look, hey, what's their 2019 amount of debt, and this is what it is. Percent of debt, we'll bump back to that. So the risk-free rate. So for our purposes, typically we look at the 10-year treasury as a risk-free rate. So right now it's very low. So our WACC is looking kind of funny, but it's at least I believe last time I checked, it closed at like 0.77. We'll just use 0.8 as a nice round number. Market risk premium, right? The historical return of the S&P 500 is, anywhere from 8, 9, 10. And then you subtract out the risk-free rate. So we'll just put 8 here for now. Seems about right. So levered beta. So we'll talk about this. And I'll tell you what I should have done. And I feel very bad because I'm telling you all guys, and I'm spending all this time saying, do what I say, not what I do, but it is what it is. So levered beta. So typically when you're doing one of these models, we would take a look at some of Walmart's competitors, look at their beta, unlever their beta, take an average of those unlevered betas, and then relever that beta back to Walmart. And if you just heard me say the word lever and unlever again, and you didn't understand, that's totally fine. Like this is very complex and unnecessarily, but right. So beta is to see, it looks at how much a company, their price fluctuates with the market, right? So a beta of 1 means that when the market goes up, you go up by the same amount. Beta of 2 means that when the market goes up, you go up 2 times as much. While in comparison, right, a beta of 0 means you kind of don't fluctuate with the market, you kind of react on your own. It's true, just correlation, right? And so if you have a negative beta, that means when the market goes down, you go up. So, things with negative beta is something like gold, while something, with a high correlation with, with beta would be, like luxury goods, right? When the market's doing well, probably you're doing well too. But that's our spiel on beta. I decided to just take the consumer staples beta. Walmart kind of is a consumer staples company. We can maybe consider them a retailer, but for all purposes, we'll use 0.7 as their beta. It works out. It kind of makes sense. This is equity. This is simply their market cap last close, Friday's closing market cap. And then basically, yeah, percent of debt, right? So now what we do simply is we do debt divided by debt plus equity as percent of debt, and same thing for percent of equity. And cost of equity, so that was that CAPM formula I was talking to you guys about earlier, right? So what we did is we did the risk-free rate, 0.8, plus the market risk premium, 8%, times that levered beta. And that's our risk-free rate. And then what we do now for WACC, what we do is we do percent of debt, right, which is here, times cost of debt, times 1 minus the tax rate, plus percent of equity times the cost of equity. And we get WACC, which will be our discount rate, because that's typically, what we're thinking kind of the cost of capital would be. Cool. So now that we have that, we're going to go back. We're going to solve out what our present value of free cash flows are, and we'll work from there. So now what we do, right, we talked about that before. So let me real quickly do a new share, right? And so this is right how we discount stuff back to present value. We do the free cash flow of that period T divided by 1 plus the WACC raised to the power of T. So, and this is kind of something we do, and you can do it or not do it. Typically we like to, in theory, do mid-year conversions because it's kind of unrealistic to think that all the cash just comes to that company at, all that cash comes at, December 31st at, midnight. Suddenly, Walmart, all of Walmart's free cash arrives on their doorstep then. we like to do it back to the mid-year because it kind of makes sense that, it's the middle point. Not all your cash comes to you January 1st, and not all of your cash comes to you at December 31st. So we like to do a midpoint. And so that's what that minus 0.5 is for T minus 0.5. So now let's bump back to our model. Hopefully that's shared for you. I think we're looking good here. And so what we'll do is we'll take the free cash flow. Whoa. Wait. So I might have just annotated my screen there. Wait, let me, one sec, guys. Oops. All right, cool. So now what we'll do, right? We'll do present value of free, or the future values of free cash flows. What we want to do is we want to do divided by 1 plus the WACC down here. And we want to raise that to the power of, right? And so I guess one thing, so what we did, these are numbers. So 2020E is just a number. So we can just do the number minus the starting year, which we're in, minus 0.5. And there we go. That's our first unlevered free cash flow. Now we can drag that formula out. And now we have the sum. We have all the, free cash flows, and as you can see, right? I guess I should go up here, right? So these are numbers. What we did. So this number or this date right here links in. And then what you can do, there's this funny function, EO month. Basically, you just do that and then 12. So it's how many months forward. And then you can just take the year of that. It's nice in the model, you don't have to have as many numbers floating around. You can just refer to it. And then it's also nice, if I want to update this next year, I suddenly just, change this to 2020 and all the things change. But that was just a little sidetrack, fun Excel stuff if you guys are into it. Oh, wait, this didn't seem to, did this not go through? Oh yeah, oops, I forgot to lock WACC. There we go. And now we're good. So for context, sorry, I did not lock the WACC, and so it was changing when I dragged the formula across. But now you guys will see it's constant across each. Yep, that's good. Okay, perfect. Awesome. Now what we'll do is we will go down to these Gordon growth, and I will forgot to clear these out. So let me delete these. All right. So we start off pretty simply. The sum of the present value of free cash flows. We just calculated those. So we'll bump back up to the top. And we'll sum these, right? And boom, there we go. And then, so I decided to do a growth rate of 1.5%. We can talk about kind of so for that, right, a growth rate, typically you don't want it being higher than the US economy because, right, if in theory you grow into perpetuity and you're growing faster than the US economy, eventually you will get to a point where your company, Walmart, is larger than the entire US economy, which doesn't really make sense. As much as we do think that Walmart is a ubiquitous part of life here in America, I don't think they will ever surpass the US economy. So typically you want to take a pretty conservative growth rate, something around 1, 2 is kind of on the high end, and typically around 1. You could also do a growth rate of 0. Some companies you think might not grow out. I know in my case, we've talked about kind of healthcare companies. You want to be pretty bearish on their growth rate, given that they really depend on innovation. But for a company like Walmart, it makes sense that they'll grow kind of 1%, 1 to 2% each year. People will always need to buy stuff. And this WACC, right? This WACC is referencing here. And then, sorry guys, I think I didn't mention. So hopefully, kind of you maybe come across this before, but we use different colors in a model. And so black is for formulas, blue is for kind of assumptions or inputs, and so those are hard-coded numbers, and then green is for cell references. And so that's why you might see. So these are all green, right? Because they're all referencing stuff we have on the sheet. And then most of these formulas are black. And then so the terminal year unlevered free cash flow, right? So what that is we go back up, and then it's this, right? So this is our terminal year. That's our last year projection. So we call that a terminal year. And so we do that. And then so what we want to do now is go off that terminal year and find, or we take our terminal year unlevered free cash flow, and we want to calculate the terminal value. And so I will quickly bounce back over to our slides, right? And so we talked about this on the perpetuity growth. So this is how we find terminal value for your for the perpetuity growth. I said, whew, a lot of words on that. So we take the free cash flow from that final year T, we multiply it by 1 plus the growth rate, which we decided for Walmart would be 1.5. And then we divide it by 1 plus, we divide it by the R, which is the WACC minus the growth rate. Kind of like we mentioned before, this is kind of just the formula that works of kind of how we do a perpetuity. And so we'll bounce back to our Excel. Awesome. And so we now have this terminal year unlevered free cash flow. We'll multiply it by 1 plus the growth rate. And then we'll divide it by WACC minus the growth rate. Let's see what happened there. Try that again, guys. Sometimes. Plus the growth rate divided by WACC minus the growth rate. Okay, cool. There we go. That worked out. And now this is still in future value, right? This is in theory in money from 2024. And so we now want to discount it, right? Same way we've been discounting before. And so we'll do that terminal year value divided by 1 plus WACC raised to the power of 2024 minus, go back, pop up to the top, minus 2019. And so the reason we don't use mid-year conversion for this year is actually because, so when we're doing Gordon growth, we're thinking that cash is going to go out into infinity. So we're not going to use the midpoint because it's not coming in the middle of 2024 because, we're still in theory functioning in 2024. We're going to put it at the end of the year. So we will not use midpoint conversion for that. And then, so stuff will then roll out. So these numbers I just took off, their balance sheet. So this is their cash from 2019, their 2019 10K. This is their debt, this is their minority interest, and that's how we get to equity value, right? Enterprise equity value. And then shares outstanding, this was from, they always list on the cover of their 10Ks how many shares outstanding. And so if we were doing a more in-depth model, maybe we would do kind of fully diluted shares outstanding and we'd look into their options. But for our case, we'll just, look at shares outstanding. I think that's a little easier. And so we simply divide equity value by shares outstanding and we get a share price. And so we get $123 and 28 cents, and we can pop back over here. I think we'll look at what Walmart's trading at. I think we're a little under 142.78, but we're not looking at the most recent financials. I think Walmart killed it in post-COVID, so we'll say that there maybe our numbers are a little under, and we didn't do them justice. We didn't put in any projections into what we thought our revenue would be and stuff like that. So it seems like a fair number, right? As I've talked about a few times, right? That was our sanity check. Makes sense. They're not going to be we didn't get a share price that was $80 and we didn't get something that was like 300. So this feels pretty valid. We'll stick with that. And so now we'll move into exit multiple. And so once again, we do the sum of the present value of cash flows. Pop back up. Right, there we go. And now what we're going to do is, let me do this real quick. And now what we'll do is we'll do exit EBITDA. And so we could go back, but we do have EBIT and EBITDA here. So we'll do EBIT, right? And then we add back DNA in that final year. And that's our final year exit EBITDA. And so this one's a little easier in terms of the math, right? So we just use that value. And so this 12.21 is the industry average kind of industry average EV over EBITDA for kind of consumer and retail companies. So we'll stick with that for now. Basically, you know, we just do exit EBITDA times exit multiple. That gives us our terminal value. And then once again, right, we want to discount that. So we'll do that divided by 1 plus the WACC raised to the power of, right, year 2024 minus our current year, or our current final year of kind of knowledge of 2019. Awesome. And then, you know, same thing, those numbers trickle down, we get that, and then we get a share price of $124.70. And, you know, it seems like we did pretty well here. I think our share prices are pretty close to each other, which is always a good sign, right? You always love to see that. And now we have kind of that done. Now what we'll do is we'll kind of go on to that little extra thing you do at the end. What we do is we like to make pivot tables, right? Or sorry, not pivot tables, sensitivity tables. This is a great way to figure out kind of where your range falls, right? So if we put in different inputs, maybe our WACC was slightly different, maybe our growth rate was slightly different. How does that impact our final outcome? And so what we have here is we'll make a sensitivity table. So for what I like to do, you know, I like to put the WACC kind of in the middle. And so we'll put WACC there, and then we'll put the growth rate here. And then what we'll do is we'll just kind of, you know, go up and down by a little bit. So for WACC, I'd say kind of maybe we'll go up by, you know, 0.5%. And we'll go, you know, down by 0.5%. And then, you know, there we go. So we kind of have those numbers in. And now for growth rate can be very sensitive, right? So for our purposes, let's go up maybe 0.1%. We're not going to try and do anything too crazy here. And we'll go down by obviously 0.1% as well. Cool. And so one thing in pivot tables, cell references are good, but occasionally they mess it up. So, you know, what I usually like to do is Control C, Control Alt V, and just paste the values. This is just because, yeah, like I was saying, kind of pivot tables can get, or sensitivity tables can get very, lack of a better word, sensitive when you start messing around with them. And so this is a nice way to just kind of make sure everything is working. And then so what we'll do up in this corner, all right, so we'll make this equal to the final implied share price from Gordon Growth. So it pops up over here. Now what we do is we just highlight this and we go over to data. Go over to data, and you go to what if analysis, and then you go to data table. And now it asks for two things. It wants your row input cell and your column input cell. And so this is our row, right? So growth rate. So we would put the growth rate here. Then our column's WACC. So we're going to put it over here. And it will populate, and boom, there we go. We suddenly have a nice sensitivity table with all the different points. And then, you know, the one thing that you have to check, right? Does this middle value equal this middle value? If so, you did it right, you're good to go. If not, something's messed up. And then one nice formatting fancy trick that we can do is we can go over here and we can make this a custom, and we can just delete this. And then if you just put 3 semicolons, there'll be nothing there. And so it looks clean. You can copy that into your Excel file. Boom, you're done. Now we'll get over here, pretty similar. So the WACC doesn't change, so we'll copy that over. But the exit multiple, right, is equal to this 12.21. For exit multiples, you know, they can kind of vary a lot. So I'll just go up by 1. I'll go down by 1 too. Control Alt V, Control Alt V, F. Delete that, and then we'll, you know, do that trick kind of we did again, where we'll highlight these, Control Alt V, and paste them as values, just so we don't get any tricky business going. And so since we're doing the exit multiple, we're going to want to go down to the share price. I'm sorry. Let me go back here. There's general. All right. So we'll want to go down to the share price, which is down here. Boom. And we're going to do the same thing we did again. We'll go to data, go to what if analysis, go to data table, right? Our row is now our exit multiple. So we'll click that. And our column is still the WACC. So we'll go up here, click that. And boom. Looks like the share prices are equal. So we did our job there. We'll go over here, do our kind of neat little formatting trick. And boom, there we go, guys. I have stuff on, or Matt and Ben, I have stuff on comps. I don't know if I was supposed to do that. I wasn't sure if I was just DCF. But otherwise, I'm happy to take questions. Matt and Ben, if you want, I can briefly go over comps too, whatever works for everyone.
Yeah, I think it'd be great to see just a quick overview of comps and how much time would you need to do that?
I think that one should be pretty quick. Comps are, at least I think, compared to what we did here on the DCF, should be a breeze. So we'll hop over there real quick. All right, cool. So you'll have to pardon me. This one isn't as nicely formatted as our previous ones. It's a little rough. Kind of downloaded this data from CapIQ and whatnot, but we'll delete this for now. And we can delete these for now. All right. So what I did, I was lazy. I downloaded Walmart's competitors from CapIQ, but they seem to make sense, right? Costco, that makes sense. Target, Amazon, Kroger's, Best Buy, and Best Buy maybe not, and BJ's Wholesale. These are all pretty logical, right? You want to pick companies that are similar, but you would want to look, right? BJ's looks a little small compared to Walmart. Maybe we shouldn't do that, but I'm not here to debate. We'll just kind of run through how to do these, and then we can think about kind of qualitatively if they make sense later, right? At the end of the day. So once you get the numbers down, it's pretty easy to go back and kind of think about them, and you'll take a look. And so I downloaded what their EV was, LTM used, and I think these are all kind of dated LTMs, I want to say, because before COVID numbers, so they might look funny to you now. EBITDA and revenue, all LTM, right? So when we do multiples, we always want to do LTM because companies have different times when they file, right? Some people have their, most people obviously have their either year end, somewhere around January 1st, but a lot of people sometimes have funky year ends. Some companies have their 10Q filed in the middle of like July, right? And when some guys are doing their Q2s, so kind of just depends. And so that's why you got to use LTM. It standardizes those numbers. So now what we'll do, so EV over EBITDA, assume you guys kind of figure out how we do that, right? We do EV and we divide it by EBITDA. And over here, right, we do EV and we divide it by revenue. And so we'll copy these and we'll copy these down. And boom, we have all our multiples. Now what we'll do is we want to get a kind of a holistic picture of what we're working with here. All right, so we'll take an average of these. But we want to make sure, right, we don't include Walmart, right? Walmart's the one right there at the bottom. And so we take an average, right? Copy the formula over. Now we want to take a minimum, right? It's good to know kind of what's the min we're working with. So, same thing, take a minimum. Want to take a median. We also, want to take a max. A few other ones, it's sometimes good if you got kind of a weird data set. I kind of also like looking at kind of first and second quartiles, or sorry, first and third quartiles. That can be helpful too. Yeah, kind of we have our things down here. And now, now we want to do the valuation, right? So we have these multiples, right? They're EV, EBITDA, and EV sales. So, now we want to figure out what Walmart's EV would look like compared to their competitors. So what we'll do is, we'll take the median multiple. For our case, we'll take median, right? Always seems to be the best way. And since this is an EV EBITDA multiple, we would want to multiply it by Walmart's LTM EBITDA. And I'll lock that. And there we go. That's their valuation. And then for this, right, we want to do, it's an EV sales multiple. So we want to multiply it by Walmart's LTM sales. So do that. And boom. And then so here's their equity value. So this is just their net debt. So you can see kind of this is just the sum of the cash minus the debt plus negative debt plus negative minority interest. So that's what that number is. And so what we just did equity value is equal to the enterprise value minus that net debt. And then and these are the shares outstanding, right? We talked about that over here, right? Shares outstanding. And then so we just do equity value divided by shares outstanding to get our share price. And so this is pretty low, but I guess it means, right? And we look at these numbers and it looks like, yeah, Walmart's kind of on the overvalued maybe compared to their competitors, right? They're on the higher side, right? Amazon kind of has this big multiple, but right, they're a tech company, right? So really only Costco has a bigger multiple than Walmart. So it makes sense that maybe, they're overvalued compared to their peers, or maybe, we're not doing the right, peer set to compare Walmart to. So it's something to think about. But, that's why we do both an intrinsic and, a relative valuation. Comps is a relative. It allows us to look at them compared to other companies. While DCF, for the most part, is pretty intrinsic and allows us to value them kind of based on their internal cash flows. And so, assume you guys have done this a million times, but then we'll take a blended average of kind of our Gordon growth, exit multiple, as well as these valuations we got here from comps, put that all together, and we'll get a target share price and work from there, But I will stop there and kind of turn it over. I think we'll have 10 minutes here for if there are any questions you guys have for me. Or Joseph or I on any of the stuff we went over here today.
Feel free to.
Oh, yeah, go for it, Emily.
Hi, thank you, Andrew, for sharing your insight with us today. So clearly, assessing the income statements is a crucial part of healthy investing, but I'm sure that not every investor is as informed as you are and as educated on this. So for the amateurs that are out there, if you had to boil it down to a few crucial components for assessing the income statements, what would you recommend?
Good question. So at least for me, and guys, so this is, probably, Joseph knows I came in when I joined Cornell Finance Club. I did not know how to model for my life. It's one of those things that you do it over a million times and you start to get the hang of it. And I'm still by no means an expert. I probably made a few mistakes today. But at least for me, I think, if you don't want to go through all this part of doing the DCF, I think comps is a nice, pretty easy way to look at it, right? These numbers are all pretty easy to pull and you can kind of get a good valuation based on your peer set, right? You could look at EBITDA, EV sales, maybe price to earnings, and give good valuation that way. Because yeah, definitely you had a point, Emily. Running through the whole DCF, when you're thinking about investing, you can't do that for every company. And so maybe comps is a nice way to get started, and then maybe start doing the DCF kind of when you have it narrowed down to one or two companies. That's kind of what I would say. Otherwise, always good to look at metrics. If you want to cheat, always good to take another, go look for some equity research and maybe figure out kind of what other people are saying in their DCFs, because those are the guys that actually get paid to do them. So that's what I would say, Joseph, if you have anything to add to that.
No, yeah. So I think the big part there is if you still want to use a DCF model, but don't want to, or don't have the time to move through a full revenue projection or a full statement model, you can always take projected cash flows from analyst or equity reports and use those in your own DCF calculations. You can still use your own assumptions, but you can take the cash flow projections from somebody else that's done that. That's another good way to go about it.
Thank you.
Andrew and Joseph, would it be possible to get a copy of the workbook we played with today to send out to members?
Yeah, happy to. I will, I'll send it to you guys. I'll clean out these sheets again, and then we have the answers back here. So we'll send that off to you guys. And then I think also we can send off the slides as well.
It'd be excellent. Thank you so much. Does anybody else have further questions? All right.
Awesome. Well, thanks again, Matt and Ben, for having us. We're always happy to swing by. It was great getting to meet all of you guys, and good luck the rest of the semester. Stay safe and enjoy it.